Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Hey everybody,
Hey,
happy
what day is
Friday.
this? Oh, it's Friday. Yeah. Good. Welcome, folks.
It is. It's Friday. And this is the, next week, this time we will be in a turkey coma.
Oh, yeah. That's right. There's a chance we're going to do our Friday broadcast as a pre-recorded. We'll see. We have guests for the weekend, so we'll see.
We love joining everybody every, Monday, Wednesday, Friday live.
Mm-hmm.
I'll probably be up and giggling with my best friend and drinking coffee about 9 o'clock.
Well, that'd be fun to bring to the morning show.
Yeah, that would be. I mean, it's scary.
Yeah.
That would really test the viewership. So
a quick update. We got on Monday, we have Stephen Karstens, another CPA accountant, is going to join us on Monday. And we're going to talk about capital markets. What Stephen and his firm seem to have a good deal of insight into kind of the movement of money, if you will, and especially at the top of the capital market. So I want to talk about that in particular and what it means to the typical buy here, pay here dealer, if anything. Yeah. So we'll cover that on Monday.
And then we've been chatting about some topics for next Wednesday.
Right.
And Jim's like, do we have to?
I got something.
I said, let's do gratitude. And he's like, we could.
We might also have a special guest.
We might have a special
guest on Wednesday. So
stay tuned. Talk to me about that? No.
I don't tell you everything I'm doing. So
he doesn't, which makes it keeps things really fresh.
Yeah.
All righty. So today we have. I'm going to go ahead and we don't have anything else, right?
Nope.
Okay. So today
let's bring in
Mr. Hugo Sanchez. Hello, Hugo. How are you?
Hey, good morning, guys.
One of the things I love, Hugo, about the morning show is I get to bring smart people. I'm bringing two smart people. I got Michelle and I got you here this morning to help with the tough questions. So welcome. Glad to have you here from Houston, Texas.
Thank you for having me. I appreciate it.
Yeah. So we got kind of a rich topic to dig into today. We were going to talk about RFCs. And I just had a new dealer the other day in a meeting ask me, because I kind of glazed over the RFC. Are you familiar with RFC? And no, what is it? So I had to kind of go through the backstory on why it matters and so on. So I thought for this morning, what we do first is kind of dig into, for those who aren't familiar with a related finance company, why don't we start there, Hugo? You want to just tell them what it is and why it's necessary?
Yeah, absolutely. So we know that the buy here, pay here space, we're doing a lot of, the financing and all that good stuff. And the IRS has said that the amount financed has to be picked up as income. We can't be on a true cash basis where we're only going to report and pay taxes on the cash that we receive that ends up going to the bank, right?
So wait, let me stop you.
Yeah,
Say that again about we're not allowed to do cash basis. So I think the people I talk to just don't even recognize, or they're kind of skirting some stuff. And so let's dig into that a little bit. Let's make sure we can't do cash basis.
So because of that retail installment contract, the IRS actually views that promissory note, that promise to pay that you have from your customer, they see that as a cash equivalent. That is that signed piece of paper is cash in the eyes of the IRS. One of those reasons is because you can go to a third party and turn that into cash. Now we know if you finance 10 grand, you're not going to get 10 grand, right? It's a prime loan, there's a discount, all that good stuff. But the IRS says, hey, you can very easily turn that piece of paper into cash. It is a cash equivalent. And so even though you haven't seen the money, you've got to report it as income in the year of the sale.
Okay, so that's what, in our industry, people refer to the paper profit or phantom profit. That's that.
IRS thinks it's real, is what I'm hearing you say, is that they treat it as real.
Correct. Yeah, we use the term phantom income all the time. Yep.
Yeah. And so I think one of the things I'm seeing, it just came up in a group meeting the other day, is what people were asking about. We were talking about months to break out. You know what I mean by that? It's like the number of months it takes in payments to recover the risk in the contract. So a lot of these dealers some of them are still under 12 months, but some of these dealers are like 18 months before they see their first nickel of profit
Right.
from a cash standpoint, right? And so that's painful to have to pay all that income tax in the first year. So that's why the related finance company came about. So you want to tell us kind of how that works?
What it does.
Right. So we create this separate entity, and it's got to be considered an arm's length transaction, right? So it's got to be its own entity, its own licensing,
Its own door too, right? Its own door.
Ideally, yes,
Yes.
absolutely. And there is an IRS checklist that, some of the things that they look at in an audit to kind of verify that this is arm's length third party transaction. But what the RFC does doesn't necessarily, it's just a tax deferral, right? So done correctly, you sell those notes over to your related finance company at a discount. And we always ask that you get a third party bid, and, you can't just say, oh, it's a flat 40% or whatever. We'd ideally like to get a bid on the entire portfolio where they don't just cherry pick notes, and use that, or at least as a starting ground for what our discount is going to be, where we sell those notes from the dealership to the finance company. And so ultimately, if done correctly, again, it's a tax deferral. So it's going to turn your tax answer, and it's going to line it up a little bit more with collections than having all of this tax up front at the beginning of the deal, when, again, like you said, we're over a year away from even breaking even on the deal. And so by using the RFC, we're able to kind of kick the tax can down the road a bit, and again, match it up a little more with collections.
And that's because a finance company is taxed differently. It doesn't experience income until it collects payments, right?
Correct. So the finance company is simply just picking up the interest income, right? The finance income. And then that discount income. So you get an upfront, let's just use 30% in our example here. You get a 30% deduction on the sale of the notes on the dealership, that the dealership can take that loss on sale of the notes in that year, right? In the year of the sale of the vehicle. So they get a 30% deduction for selling the notes at a discount.
Okay.
That 30% doesn't turn into income on the finance company until that collection happens. So that 30% discount is amortized as income over the life of that loan.
Gotcha.
So that's one of the reasons why, most people that are starting an RFC, it's kind of something you can do at the 11th hour.
Correct. So as long as the entity exists, as long as all the right licensing in place is there, and we have a capital source, right? We want to be able to pay for those notes, because you're not going to sell the notes to a third party that's not going to pay you for them. So again, we want the transaction to be done correctly, but ideally, in that first year, it's my tax heaven right there. In that first year, we are able to just sell the notes on December 31st at 11:59 p.m. right before you go, do your midnight kiss, and you still get that deduction, that loss on sale of notes, all in that for that year. Right. When I'm assuming here we're talking about a calendar year taxpayer, of course.
Yeah.
But,
yes.
That's not my definition of tax heaven. Like you're doing your midnight kiss, standing in front of your DMS software. I mean, come on, we could do better.
Oh, honey, look what we just saved. Disneyland.
It's so much fun. What are you talking about? So, but we've got a little bit of wiggle room there on how much notes we sell, exactly when we sell them.
Yeah.
So it's the perfect tax planning opportunity. And of course, years 2, 3, and 4, the RFC is always great as well. But in that year 1, you're pretty much deferring 100% of that tax, or that discount, without having to pick up any discount income.
Yeah. It's really interesting. We one of our niches, did I say that right? Is putting new dealers into business. So we go through this with all of them, and it's like, they'll like if they're starting their business in October or November, it's like, let's wait until next year. But it's one of those things that we in an engagement is that we will help them do that. And it's just it's interesting, when you're doing cash flow modeling, which is something we do at the very beginning, is you talk about all the cash that's needed to buy the car and to do the thing and all the stuff and get yourself into business. And taxes are like, that's big chunk. And we were just talking this morning about a future podcast that we wanted to do how
let's
that
run
moves
that
the
scenario
needle.
by Hugo at the end of the conversation here, because I don't want to get away from RFCs at the moment. In fact, I want to come back, Hugo, and I didn't prepare you for this question, so if we need to answer it later in the comments or something, we can dig in a little deeper. But on this matter of, I want to emphasize the word related in the RFC thing. Like, I know there's some rules around common ownership. Are you familiar? Like, what's the significance of related?
Right. So for the most part, it's I don't know off the top of my head. I don't know exactly what the percentages are, but you're absolutely right. It has to do with the common ownership of the entities.
Okay. Yep. And that's just, again, the arm's length thing, and we have to satisfy that. And so why would the IRS care? Because it's a tax strategy, and it can look like a false tax strategy if we don't do it correctly. Yeah. So the other thing I want to throw a quick mention in here, if, when we meet dealers that are new, we will tell them, look, you're either going to do leasing or you're going to do a related finance company at some point if you're doing any kind of volume. It's just a natural tax strategy. So lease dealers who are doing lease here, pay here don't need a related finance company, because leases are taxed differently than a traditional buy here, pay here retail installment contract. So, there's a lot to kind of flesh out there, but the reality is, if dealers are doing any kind of volume,
when you say any kind of volume, I'd like you to be a little bit more specific on that, because someone who's been in business for a lot, it's like, we do 5 deals a month and we are rocking it.
Yeah,
is that,
I'll let
Hugo
answer about that. My answer is different than it might've been 10, 15 years ago. Hugo, what do you think?
We typically recommend the RFC, or at least start talking to a CPA about setting up the RFC once you hit about $500,000 in principal receivables, right? At that point,
$500,000 in principal receivables.
Right. Okay. At that point, selling the notes and the volume that you're most likely doing at that point, it's beneficial, and the benefits outweigh, because there are absolutely additional administrative costs, right? There's a whole nother entity to run. There's a whole nother tax return and set of financial statements you've got to put together, et cetera. So at about $500,000 principal AR, that's when it's worth kind of the additional headaches and hassles and administrative costs of running all that second company. It offsets your tax bill enough to make it worth it.
Yeah, and that headache factor can be a real thing. But that's part of why my answer is different today than it was years ago, because the software makes it easier now than it once was. And keep in mind, Hugo, when I started my dealership in 2005, I wasn't familiar. I set up an RFC in 2006 or 11, or 2007, I can't remember. But I had to get in there and learn all the accounting, right? It was, all these numbers moving back and forth between the entities, and I had to kind of learn. And I jokingly told people over the years, I ended up learning more doggone RFC accounting than I ever wanted to know, but it's like you had to do it as a dealer to understand your business and kind of understand how that stuff is moving. But I want to break down a little bit. And by the way, for our folks that are tuning in that have an existing RFC and they're kind of looking for close of year strategies, we'll kind of cover that in a minute. I want to break down a little bit further, because some of these things also would be a factor with established dealers. One of the things that I remember many years ago, having a conversation with a dealer, very intelligent, large operation, and we had a kind of a back and forth dialogue around this thing about the benefit that you enjoy in an RFC. And I was sort of making the case in that conversation that, a dealer would enjoy the most benefit in the first year that they experience that. And so, bear with me, part of the thinking there is, obviously, if you and I start a buy here, pay here dealership in Houston, Texas, we're going to have pretty good profits on the books in the first year, right? We're going to, until we do something to discount the notes, we're going to have quite a bit of profit on the books. And then, but if we continued into the second year without establishing RFC, now repo losses start to happen. And so the losses that we would experience in year 2 are going to start to offset some of the new income that on the new contracts. So my theory that I sort of brought forward is that dealers, even though there's always ongoing benefit, I felt like the maximum benefit would be enjoyed in that first year. Do you follow that logic?
Absolutely. I think it's the biggest benefits come from one of 2 years. Number one, I agree 100%. It's in that first year, right? Because again, you get to take that loss on selling notes without having to pick up any discount income on the finance company. Right. And the other one is when you just have a very explosive growth in your portfolio in just 1 year, right? Going back to a couple of years ago when these dealers were selling their cars left and right, and they were showing quite a bit of profit. Years like that, it's also very beneficial just because you can take a bigger, more growth that year, more sales that year means more finance and a bigger loss on sell notes in that particular year.
So it might be a bigger benefit, but all the years in between are a pretty substantial benefit.
Correct. Absolutely.
It's kind of complicated to explain verbally, but it's, better shown graphically. But the reality is, they're going to discount income every year that they have new contracts. And so they're going to move that off of their dealership side. And so I think one of the things too that we see in doing that is, as you said, arriving at the discount that first season is going to be basically you want to get some bids, external bids to arrive at the real value of the portfolio.
Right.
So, I mean, you'd mentioned 30%.
Yes.
So, and that's number is then typically based on when you have someone evaluate your portfolio, what kind of discount are they going to ask for? Is that, how are we arriving at 30%?
Right. So 30% is kind of our internal starting point. We do ask dealers to go get a bid, and so it can be a little higher, a little lower. And that's a great planning opportunity this year. Market's been a little crazy. The bulk buying market, hasn't been great the last 6 months. And so there could be an argument to increase that discount a little bit more, because if we go to a true third party and sell that paper, we're not going to get anywhere 70 cents right now on the dollar. And so we can actually adjust our discount, a little bit more.
I have one more question. And this is basic.
That's what we do here. Go ahead.
Basic elementary. So what is the reason that notes end up being discounted when that's evaluated?
Because we know we're not going to collect all of it.
Okay, so it's because you're not going to see all these notes go to the full term, and so it's basically probably. I mean, does it have anything to do with the market and how often, or is it per dealer or whatever? Because a dealer can have a lower repo rate or a higher repo rate than somebody else. So is that one of the factors that would determine
all of it?
Okay. Gotcha.
Yeah. So it's, we know it's subprime lending. So even, some of these bulk buyers will look at what your underwriting looks like. If you do absolutely zero underwriting, there's, hey, you've got a pulse. Higher. You've got a pulse, we'll sell you a car. The discount on that is going to be a little bit higher because there's just no real underwriting done, right? Versus somebody that's maybe using a scoring model, or they're a little tighter on their underwriting, et cetera. They could negotiate a slightly better discount that benefits them a little bit more and get a little more money in their pocket, because those notes might do a little bit better. But it's, basically just, we know we're not going to collect at least a third of what we sell. And that's exactly where the discount's coming from. If you look, the mortgage industry does this as well, but they've got a little bit better collateral, right, that they can repossess, et cetera. So like if you look at mortgage notes, they're going to sell right at 100% or so. There's not a big discount for them whatsoever, whereas our industry just doesn't work that way.
Yeah. And I think you said, we know it's subprime, but it occurs to me that some inexperienced IRS auditor might not recognize that we're in subprime. And so we have to be able to lay that out, right? We have to tell that story in our our defense of whatever discount, we're choosing there.
Because we all know with the IRS, you're guilty till you're proven innocent.
Yeah.
Absolutely. And I, during audits, I sometimes have to spend half my time teaching the auditor how to do their job and, stuff like that, because they absolutely don't understand what's going on very often.
Yeah. So I want to get back to one that we hear from time to time, and we're over here, we sometimes have to lean in the microphones and say, we're not lawyers or we're not CPAs, right? So we have to disclaim, but we talk to dealers sometimes and they're saying that their CPA is doing some sort of loss reserves, that they don't have an RFC, but they're doing these loss reserves. So can you talk to us about that? Are there specific provisions around that?
So the IRS does not like estimates, right? You can't really deduct estimates. And so typically if you're on the GAAP basis for an audit or something like that, there is just like a reserve that's a nice flat round number. But we actually, when we prepare the tax return, we don't turn around and deduct that same number, right? We go based on what actually happened, not estimates or CECL calculations or anything like that at all. But typically, we absolutely have to deduct what actually happened, not what is probably going to happen. And so when you do like a flat 30% or something like that, the IRS does frown upon that.
Yeah. So one of the things we do, Hugo, with clients that we have like an ongoing relationship with, especially if it includes data reporting and that sort of thing, one of the things we'll do is we'll track portfolio performance. And I typically take 12 months worth of historical performance results, and we will then project or extrapolate a 12, 24, and 36 month roll forward that says, so I was having fun thinking, if Hugo, you had an audit coming up with one of your clients and you suddenly fell ill, and I had to step in your spot, one of the things I would be doing is saying, look, this is the most we can expect to yield from this portfolio based on the historical collection results, right? And of course, here we are having this conversation in late 2023. We're seeing dealers have increasing repo rates. We're seeing, we see the data that says bankruptcies are up 17%. And so it begs the question, what kind of adjustments then are we looking at for dealers that are facing the close of the year? What kind of measures would you be recommending that they take? And let's don't wait till, the 28th day of December. What steps can we be taking now to make sure that we're doing
if you already have an RFC?
Already have an RFC,
okay.
And we're looking at some close of the year corrections.
Yeah, so I think the first thing I touched on already, but it would be adjusting that discount. The market has absolutely changed over the last 12, 18 months or so. And so maybe getting a fresh bid on those portfolios and get an idea of what that discount income is, or I'm sorry, what that discount should be based on your existing portfolio will make an absolute tax difference right now. Another thing would be to even maybe stop selling notes from your dealership to the RFC, right? If we've kind of got enough repos that's offsetting a good amount of our income that we've made for the year, why sell more notes and why take a bigger loss on seller deductions if we don't need it, right? We can push that into 2024, 2025 once the market starts improving a little bit more. Yeah. So we, absolutely knowing how many notes to sell and when to stop selling notes is one of the bigger things.
That's when you said to get your portfolio, have someone do a bid like this is what it's worth. I'd like to officially apologize to everyone out there that does that because it's like, yeah.
What did you tell them, Michelle?
Huh?
What did you,
I'm apologizing because they're gonna get this influx of people that say, "Hey, would you do a bid on my portfolio?"
I try to give them, we're friendly with lots of people that do it in the industry, and I try to tell them, hey, look, and what most of them have said to me is, look, we don't mind doing it. We know we're probably not going to do business on this deal. I get that it's, you've kind of got your own reasons for doing it. But they're also sometimes willing to do it just because it's an opportunity to do business in the future. If that dealer is ready to sell notes, they've already established communication with them. They already have some of their information. So
smart.
Sorry, guys. I know it's a little extra work, but we're playing the long-term game here, right?
It's the 10-year approach too.
Right.
It's the long game. Yeah.
Yeah. Exactly. And some dealers may develop a need to sell next month and they'll have an idea what the process is like. And
they'll already have a relationship too. So,
I think it's kind of interesting though, if we got bids back from 3 different bulk buyers, those numbers would vary a little bit. And I just find it interesting that, their own criteria, their grading criteria and their own threshold for risk would vary a little bit. And so you would see some disparity there amongst the bids, I'm sure, but this is the reason to get multiple ones and be able to justify that. But I think what I'm hearing you say is if you're a new dealer and you started in 2022 or whatever, and you started at the standard 30%, and now you're going to want to look at portfolio valuation. You're going to want to look at portfolio performance and make sure that you, as their CPA, can defend the rate that they have chosen, the discount rate, right?
Right, absolutely. So we look at a little bit of everything. Again, we want to treat it as a true third-party transaction. We want to see that, the discount makes sense. We want to see the RFC paying its fair share of expenses and, existing as its own company. It's not like the dealership's paying 100% of everything. We want to see, making sure that it makes sense, right? And one of the big things is we want to see that the finance company is paying for the notes, right? Again, if you go and sell these notes, you aren't going to want to just get paid little by little over the next 24, 36, whatever months, as the finance company is collecting on it. You're going to want some of that cash up front.
Yeah.
And so we want to see that, that intercompany balance and that the finance companies has the money and the capital to put that back into the dealership.
Gotcha. That's good stuff. I think, you answered my questions, Michelle.
There's one thing that Jim has on the bottom of because we like to take notes and, this is like the stuff, horror stories by
RFC
Hugo Sanchez.
We should have brought you on Halloween.
I'd say I actually have one that's by not using an RFC, we were stuck, right? We had a dealer that OCCC was just running crazy behind on processing licensing. and the dealer started the process a little bit too late in the year last year. So the RFC didn't have the right licensing to be able to purchase the notes. And so we were stuck with an ugly tax answer, right? It was, we had no RFC to sell the notes to, and so everything stayed on the dealership side. So that was a little bit of a horror story, right? If you're going to get started with the RFC for 2023, my recommendation would be as soon as we're done here, go and start making the right phone calls and doing all that. It all depends on state licensing. And I've had some mixed stories from the OCCC. Somebody recently told me that they got their stuff back in about a month. Another person did tell me, hey, they're still back up to 90 days again. So in Texas, it's kind of hit or miss from what I understand. So, depending on what state you're in, it may or may not work. You just important to get those licenses by December 31st.
Well, let's plan to have this conversation in September next year. So folks, because you're right, the licensing delays would be among the significant things. And then one of the things we see is, we're currently working with a client who's in the middle of a software switch, and part of the motivation of the software switch was, be able to manage the RFC better. And but we're in a pressurized situation because the onboarding and the build period of the software is going to put us right up against the deadline. And so it's uncomfortable. I think it's better for dealers to prepare and plan for that. But I think the first thing for today, we just wanted to know that this is a strategy that's available. Sure. It's common. The IRS totally allows it. There's a very special provision for this, and so it's important for people to know that's an option. And so for those folks who are properly licensed and maybe need to make some adjustments, they can still do that at the close of the year. I have one other thing I want to talk to you about before you go. Did you have something, Michelle?
Well, it was kind of like one of the drums that we beat all the time is be really careful about what DMSs you choose. Because some are easier and some are not. Mm-hmm. And they typically what our experience has been is you get what you pay for. So some of the least expensive DMSs out there are going to be the hardest to work with.
Yeah, absolutely. Some of them are a little more RFC friendly than others.
Mm-hmm.
Yeah. So one of the things we've done, Hugo, over the years, Michelle mentioned earlier, is kind of we satisfy with some clients what I call liaison role, where we try to sit between the dealer and their software and their CPA, who often is not familiar with this whole RFC thing. And so there's one more reason that, look, if you're in a place where you've got, a pretty significant operation, and I would say even less, gosh, what's a tax bill cost? Maybe don't make that mistake. Let's hire people who know the stuff. And obviously you folks at Butler and Sanchez, you guys know this RFC stuff well. You live in that space all the time. It's a very much a focus of your business. And so we just know the value of hiring somebody who's a specialist. And so we know that would be true.
Jim has said he's not an accountant, but he's trained a lot of accountants.
That sounds like I have to explain. That sounds like I'm real smart. I have had to educate some CPAs on the RFC
because they're not familiar with
where
it.
to find this arm's length checklist and all this stuff. And so we've had to kind of walk them through that. And we have gotten quite familiar with the RFC accounting and how those dollars move back and forth. And so it's really important because even the dealer now understands the RFC after watching the morning show and the CPA is starting to get some idea, they still don't really understand how it's going to work in the software. Right. So there's still some stuff to figure out there. And so we try to make sure we can help people kind of, bridge that gap and bring it all together. So my question, are we ready, Michelle? Did you have something else?
I wanted to, before you ask your question, Hugo, if people need to find you, how's the best way for them to find you?
Easiest website to remember, BHPHCPA.com.
Super easy.
Yeah.
Wow.
Okay, so I'm going to put
that
BHPH CPA, and I'm going to throw that up there so that if you are in need of Hugo's amazing and the firm's talents, this is where
that's a good place to go. So here's a question for you, Hugo. I was working with some cash flow modeling with a new client the other day, and I have this cash flow tool that I built. So it's kind of 5-year projections. Of course, when we work with a new dealer, we're super focused on the first year. It's brand new for them and they're trying to figure out how much cash before it gets cash positive. And one of the things I recognize in a way that I'll bring it back to a morning show and show it on the screen one day, but in working with the modeling, I had all the numbers static across the 5 years, same selling price, same cost of car, all the numbers are the same, locked in across the 5-year model. And I went to the model, and in the first year, I increased the selling price only. Rent, same cost of car, same down payment, all the rest of the structure the same. I just increased the selling price.
Right.
And you probably can guess that the cash required of the dealer went up. So it's like, so think about, from a cost, we think about that. Well, our cost in the car is the same. Our down payment, our cash that we have there is the same. So it took me a minute. I mean, all the years I'm doing it, I was like, whoa, why did that number go up? All I did was move the selling price. And so it's sales tax and income tax.
Right.
All we do, we're creating more markup, which is back to this phantom profit, right? That phantom income. We're not going to collect it. And it costs us more. And this would be true every year. Right. It's easy to illustrate on the screen in that one scenario where everything else is static.
Right.
But when I increased the selling price, the cash required to run the operation went up.
Yeah, no, that makes sense. It's, the additional sales tax, the additional taxes, income taxes, all that good stuff. Again, on phantom income, it's on cash that we're not going to see for 2-3 years, depending on your terms, if we even see it, right? Because again, we know we're not going to see a good percentage of it. Sure. So it absolutely makes a difference.
And the RFC obviously helps manage the income tax, which, as we've spent our time talking about here today, would help discount the income. But I'm just saying, even with that discount in place, the cash required still went up.
Right.
So, it's just important for people to really stop and think about that. And so I think, expect to see that as a topic for a future morning show.
Absolutely. Okay. So if you all are looking for a CPA, BHPHCPA.com is where y'all need to go. We do know from a lot of our clients that it's like, we've had the same CPA since my dad ran the thing 28 years ago, whatever. So if you need some help with getting everything organized and a liaison with your CPAs and all of that, give us a call, because that's something that we can help with.
And what's peace of mind worth? Like we say that with clients all the time on some of these subjects. It's like, what's peace of mind worth to you? You need to ask yourself that. What's it worth to sleep well at night and knowing you're audit ready? It's like, that's worth a lot.
So call or text to 903-816-0216. If there's something that's for us, that's for Jim and Michelle and White Hat Coaching, because we're changing.
And if you have questions we can't answer, we'll give you Hugo's number.
That work?
Well, and also if you also are looking for a little bit more information, I know that Hugo and Amanda, it's been kind of our passion project, the boardroom, the BHPH boardroom, and that there are pieces in there about RFCs as well. And so you can get into the boardroom.com. As well, and learn a little bit more there. So, Is
that right? Theboardroom.com?
BHPHboardroom.com.
Thank you. BHPHboardroom.com. So head there as well. And
plenty of videos there as well.
You can get a little bit more information and probably cement some of the things we talked about today.
Yeah. So Hugo, thank you, sir. We appreciate you making time to chat, and that was very educational.
Yeah. Do you want to stick around for just a second so we can say proper goodbye as soon as we've closed up? Excellent. Thanks, Hugo. All righty. Good information. Good and one of the things that when we were talking this morning about this topic is we're kind of running like that whole changing the price, how that is different in buy here, pay here versus lease here, pay here too. So, all righty. What else?
I can't think of a thing. Just remember, we got Stephen Carson's coming to talk about capital, and I think that'll be rich. I know Stephen, based on what we've seen, them out there sharing on social media, they've got some insight that I look forward to, talking through and kind of get a feel for what's happening. And so I just think it's interesting. We've been around this business a good while. We've been through some ups and downs and the economic swings, and we have plenty of dealers that we know that have lived through it. And so we want to talk about what it means to the typical dealer, and really we'll end up talking about, is this a good time to be getting in the buy here, pay here business? We're hearing from a lot of people who are looking to get in it, even though the cost of cars high, economy's tough. It's like, and suddenly there's a ton of interest in the space. So it'll be an interesting conversation with Mr. Carson's on Monday.
All right. Well, I am, it's Friday.
Yeah. It's time to
do Friday stuff.
Good. Yeah. Let's go do Friday stuff. That's exactly right. Yeah, look at my Friday.
All right, everybody. Have a great rest of your day. And we will see you on Monday with Stephen Carson. Thanks again so much, everybody.